As you're watching this, a structural breakdown is unfolding within the global financial system. The silver price displayed on your screen is a fabrication, a carefully constructed illusion meant to conceal the most alarming reality Wall Street has ever confronted. Today, Wednesday, marks a turning point. The Federal Reserve is publishing its meeting minutes. The gamma squeeze mechanism is warming up, and the physical vaults are hemorrhaging at a pace that mathematically ensures a default. We are witnessing the collapse of the paper market in real time. What unfolds over the next 24 hours will decide whether you end up on the winning side of the largest wealth redistribution in history, or whether you're left clutching worthless paper commitments. Before we reveal the Wednesday bombshell, let me state this unequivocally. I will never solicit your money. No paid communities, no programs, no coaching. If anyone invokes my name to sell you something, it's fraudulent. Report them. I produce these videos because mainstream media is deceiving you. They're burying the data. I'm here to present the mathematics. This is educational content, not financial guidance. Confirm everything independently. Links are in the description. Leave a comment if you're prepared for the reality. The Tuesday shakeout. Let's begin with what transpired today, Tuesday, February 17th. You look at your screen and see silver declining. You see red. You see fragility. Spot silver hovering between $74.24 and $75.16 per ounce. A notable pullback from the January peaks that briefly approached $121. Why is this occurring? Mainstream outlets will attribute it to dollar strength. The DXY climbed toward 97 following Kevin Walsh's nomination as the incoming Fed chair. The market reads this as a hawkish signal. Elevated rates, firmer dollar, softer metals. That's the storyline, but it's not the reality. The reality is that today's price movement was an orchestrated liquidation maneuver, a position rotation carried out by the world's largest financial institutions. While retail traders were dumping in fear today, who was accumulating? Who was soaking up millions of ounces in paper contracts at $74? The very same banks that shorted it at $120. They drove the price down to exit their short positions, to wipe out your leverage, to acquire your holdings at a bargain. And now they're pivoting to the long side. The Tuesday shakeout wasn't a collapse. It was a transfer, a shift of wealth from the impatient to the knowledgeable, from the leveraged retail participant to the institutional giant. And they executed it just before the Wednesday bombshell lands. Here's the data point that should alarm anyone holding paper silver. The figure that demonstrates the system is fractured. February 11th, 2026, official COMEX figures. Registered silver stockpiles plummeted to 98,138,500 ounces. Read that once more. 98 million ounces. For decades, 100 million ounces served as the critical boundary, the safety margin, the minimum quantity of metal needed to sustain trust in the delivery process. We've just breached it. We're now in uncharted territory. Registered silver is the only metal genuinely accessible for delivery. It's the only metal that can fulfill futures contracts. COMEX will point to 400 million ounces in eligible reserves. That's misleading by omission. Eligible silver is owned by private holders. It belongs to ETFs. It belongs to banks. It's not on the market. It can't be used to fulfill contracts unless those owners choose to part with it. And judging by the premiums, they're not parting. So we have 98 million ounces of deliverable metal, and March delivery is approaching, the largest delivery month of the year. Do you know what the open interest stands at for March? Over 400 million ounces. That's a 4-to-1 imbalance. 4 paper claims for every single physical ounce in the registered vaults. If just 25% of contract holders demand delivery in March, COMEX defaults, mathematically, physically, inevitably. This is precisely why they tanked the price today. They need you to exit your contract so they avoid having to hand over actual metal they don't possess. The great separation, Shanghai versus New York. If you need evidence that the Western price is artificial, look eastward. Look at Shanghai. While New York trades at $75, the Shanghai silver benchmark sits at $87.50. That's a $12 premium. Roughly 17% higher. In a properly functioning market, arbitrage would eliminate this disparity. Traders would purchase in New York at $75, transport it to Shanghai, and offload it for $87. Effortless profit. But they can't. Why? Because China disrupted the arbitrage mechanism. Starting January 1st, 2026, China enacted export licensing controls. Only 44 government-approved firms with $30 million credit facilities can export silver. This established a one-directional flow. Metal can enter China to capture the premium, but it cannot exit. The consequence is a vacuum, a physical extraction. Silver is being drained from London and New York vaults and routed to Shanghai. It enters the Chinese industrial ecosystem and never resurfaces. Western storage facilities are being emptied to meet Eastern appetite. And because the metal can't return, the price differential is lasting. The genuine price of silver isn't $75, it's $87 or $100, or whatever the physical market dictates. The paper price is a phantom, a remnant of a marketplace that no longer functions. Now let's discuss tomorrow, Wednesday. Why am I labeling it the Wednesday bombshell? Because the market dynamics are configured for a forceful reversal. We're monitoring a substantial options barrier at the $120 strike price. But more critically, we're tracking market maker behavior. When silver plunged on February 12th, the banks didn't merely close short positions. They purchased call options, enormous quantities of them. If silver maintains the $74 support level, market makers who issued those calls are cornered. As price ascends, they're compelled to acquire futures contracts to offset their exposure. This purchasing propels the price upward, which compels them to buy even more, which pushes it higher still. This is a gamma squeeze, a self-reinforcing cycle of compulsory buying. Tomorrow, the Federal Reserve publishes FOMC minutes. If there's even a suggestion of dovishness, even a murmur that they might halt rate increases or reduce them later in 2026, the dollar weakens. And when the dollar weakens, the gamma engine activates. We could witness silver jumping $5, $8, even $10 in a single trading session. Not driven by fundamentals, but by mechanics. Because the banks constructed the trap, and now they're triggering it. The projected target for this move, the technical wave B target, is $92 to $94 by week's end. That represents a 25% surge from current levels within days. This is why they flushed you out today, so they can ride the surge tomorrow without you on board. While traders play their games with paper, the physical world is exhausting its metal supply. Let's examine the industrial abyss, the demand that's indifferent to price, artificial intelligence. You're familiar with NVIDIA. You know about the Blackwell and Rubin chips, high-performance computing. But do you know what prevents those chips from overheating? Silver. Silver possesses the greatest thermal conductivity of any metal on the planet, 429 watts per meter Kelvin. Nothing else is comparable. As AI processors grow more powerful, they generate more heat. They require more efficient thermal management. They need silver-based thermal interface materials, TIMs. This silver is deposited in microscopic films. Once the chip is utilized, that silver is essentially lost, too costly to recover. It's consumed, evaporated, erased from the worldwide supply. OpenAI is developing data centers with 25 gigawatts of capacity. That's $1 trillion in infrastructure. Every server rack demands silver. This is inflexible demand. NVIDIA doesn't care whether silver costs $75 or $750. They need it to make their $30,000 processors function. They'll pay whatever it takes. And they're competing with military purchasers. This is the intelligence nobody's discussing, the weaponization of silver. Reports indicate Israel has incorporated 420 tons of silver into its Silver Dome defense system for electromagnetic pulse protection and critical infrastructure shielding. But the bigger story is hypersonic weaponry. The U.S. is scrambling to match China and Russia. Mach 5 missiles. At Mach 5, atmospheric friction produces temperatures that destroy standard electronics. You need silver-based semiconductors and navigation systems to endure the heat. Every Tomahawk missile contains 500 ounces of silver. When that missile reaches its target, 500 ounces of silver are vaporized, permanently gone. The Pentagon is a massive purchaser, one completely insensitive to price, and they're depleting the same reserves that Apple, Tesla, and NVIDIA depend on. We're entering an era of strategic resource competition. Silver isn't merely currency. It's a strategic asset, and nations are stockpiling it. Tomorrow introduces another threat to the bearish case, the employment illusion. The Bureau of Labor Statistics recently revised its 2025 figures. They wiped 1.1 million jobs from the records. Consider that. 1.1 million positions the government claimed existed were never real. The robust economy was a fiction, a statistical phantom. The Fed raised interest rates based on these numbers. The market priced in expansion based on these numbers. Now the truth has surfaced. The economy is frailer than acknowledged. We're likely already in a downturn. When the market fully absorbs this, the narrative pivots from soft landing to hard landing, from elevated rates to emergency reductions. This favors gold. This favors silver. This is the catalyst that undermines dollar strength. Technical analysis, the decisive level. Let's review the charts, because the technical indicators are signaling a critical juncture. Support zone, $71 to $74.40. This is the foundational demand area, the 200-day moving average, the prior breakout point. We tested this zone today and rebounded. This forms a triple bottom pattern on the hourly charts, a textbook reversal formation. If $74 holds, the path of least resistance points upward. Resistance zone, $80. This is the pivot point, the psychological threshold, the gamma trigger. If we breach $80 tomorrow, the squeeze is underway. The target shifts to $85, then $92. Bearish scenario. If we close beneath $71, the structure fractures. The next support sits at the Fibonacci 38.2% retracement at $65.11. But considering the inventory picture, the Shanghai premium, and industrial consumption, I view any decline to 65 bios not as a breakdown, but as a once-in-a-generation buying opportunity. Don't trust the screen price? Attempt to purchase physical silver? Visit APMEX, visit JM Bullion, visit your neighborhood coin dealer. Ask for American Silver Eagles. They'll quote you $95, possibly $100. That's a 30-40% markup over the spot price. Why? Because they can't obtain inventory. Dealers are reporting 6 to 8 day shipping delays. Wholesalers are limiting supply. The U.S. Mint is on allocation. The physical market is dysfunctional. The paper price tells one story. Reality tells another. You cannot acquire silver for $75. That price doesn't exist in reality. It's a fiction sustained by COMEX to resolve paper contracts. If you want actual metal, you pay the actual price, and the actual price keeps climbing. Everything converges on February 27th, first notice day. In 10 days, the bluff gets exposed. COMEX holds 98 million ounces. Open interest stands at 400 million ounces. If the major players demand delivery, if industrial consumers require metal, if banks want their physical holdings returned, the exchange collapses. Force majeure. Cash settlement. This is the tipping point. When an exchange defaults, prices decouple. The paper price drops to zero or becomes meaningless. The physical price skyrockets. This occurred in the nickel market in 2022. The LME voided trades. They altered the rules. They shielded the short sellers. But they cannot fabricate silver. They cannot manufacture physics. If the metal doesn't exist, the charade concludes. So what's your move? How do you ready yourself for the Wednesday bombshell? Do not panic, sell. If you endured the downturn, don't exit at the low point. You've weathered the shakeout. Don't surrender your position now. Monitor $80. That's your indicator. If we cross $80 on strong volume, the reversal is validated. The squeeze is live. Tune out the noise. Media will fixate on the dollar. They'll discuss interest rates. They'll overlook the vault inventories. Concentrate on the stockpile data. Concentrate on the premiums. Concentrate on the physical reality. Evaluate your holdings. If you own paper, SLV, unallocated accounts, you face risk. If COMEX fails, paper claims get converted to cash settlements. You forfeit the upside. If you hold physical silver, you're secure. You possess the actual asset. Zero counterparty risk. Brace for turbulence. Tomorrow will be intense in both directions. They'll attempt to rattle you one final time. Maintain your composure. They want your silver. That's the only rationale for what we're observing. Why suppress the price when stockpiles are at record lows? To shake loose those with weak conviction? Why raise margin requirements when demand is surging? To compel forced selling.